Hey, back at you with another video. I wanted to just make a quick video about some of the measures or metrics that traders or those in the stock market use to get a sense of how the future might look. And, well, as the name implies, one of those is to look at what's called the stock market futures. The futures is, and I'll fully admit, not something I fully understand in terms of the trading action that happens. So there's different types of traders, like I said in episode 1, and there's traders like myself who trade stocks. I buy them low, sell them high. People that trade futures will actually take positions on where they believe the stock market will be headed in the future, hence the name futures. Now, even if you're not trading in the futures and you're not taking those types of bets in future market action, the data is available for everyone to look at, and it can be very useful when you, as an investor, whether you're buying and holding Warren Buffett style, or whether you're trading, getting a sense of what the futures markets are predicting for how the indexes will behave in the future can be very important. So for me, and I can't speak for other traders, but I'll talk about myself. I reference the futures constantly. And so it's Friday night right now. So the market's not open tomorrow or Sunday or Monday because of the holiday. But generally, if this was Thursday night and it's 7:23 p.m. on Friday the 29th, typically though, if this was a work night, as in tomorrow the markets will be open, these numbers will be fluctuating and giving investors a sense of where futures traders are predicting the market will be. So if we just look at this, NASDAQ futures right here, if we can assume that tomorrow is a trading day and that these are actively traded numbers, this would say that, okay, people are projecting that tomorrow, when the market opens, the NASDAQ is going to be down 1.22%. Now, that's actually quite a big number. If you have, for example, $100,000 in your stock portfolio, a 1.22% could be, a drop or a dip in your portfolio of thousands of dollars. So a 1.22% drop is pretty big. So these numbers can give you a sense. Now, let's fast forward, though. So let's say, I wake up tomorrow morning and the stock market, the New York Stock Exchange opens at 9:30 a.m. Eastern Time. So let's say it's 9 a.m. I'm looking at the futures, and the futures are down. They're projecting that when the market opens, the market's going to be 1.22% down in the red. Well, I can look at that and determine that, okay, well, it's probably likely the market's going to be down a bit when the market opens. So that can be very useful because I can use that information to, kind of calibrate how I'm going to behave when the market opens. So typically when the market opens at 9:30, there are millions of orders that get executed all at once. Buy orders, sell orders, and they all at once just get executed. So if I see the stock futures are predicting a 1.22% drop, I can be pretty certain that, all right, well, in the beginning of the day, I shouldn't expect for my stocks to just skyrocket upward. Sometimes they do. So this can be useful. Now, once the market's open, you have other things that you can use, other tools, to kind of put this in context. Now let me actually explain what I mean. So I'm going to go back. So there's just different tabs here. This is Seeking Alpha. I have a premium account here. If I just go back to US, so this tab, we're not in the futures anymore. Let's say it's 9:30 and the stock market's open and it's trading. And I look at this and I go, okay, if the stock market right now, this very second, is 1.15% in the red. And I look at the futures, and the futures are predicting a 1.22% drop. So the folks that trade futures are predicting that given this point in time that we're at now, the NASDAQ will continue to drop from 1.15% down to 1.22%. Now, this is just my own personal analysis, but what I have found is that sometimes you'll see very, very, very tight numbers. And I think what I'm going to do is pivot into a Word document here. Let's say the current, I don't know what you call it, the current rate for the NASDAQ, let's just call it that, is 1.22%. The futures are predicting, let's say, 1.23%. You'll often find that the difference between where the market is currently and where the market is predicted to be is almost the same. So when I see this, my interpretation of this, since the difference is so slim, is that the market doesn't really know, at least not with a lot of confidence, where the future direction of the market will be in the future. Now, if you see something like this, so right now, let's say the NASDAQ is down, we'll put a negative here, negative 1.22%. Let's say the futures say this, 4%. If you see something like this, there is a big difference between 1.22 and 4%. So if I were to see this, this tells me that people far smarter than me have reason to believe that the market is going to drop aggressively down to 4% in the imminent future. That's significant. This to me says, whoa, that's a big deviation. A 4% drop, by the way, is huge. That's like billions of dollars pouring out of the stock market. 4% is a very significant number when you're talking about price action in the stock market. So if I see this, that actually gives me more confidence into what the future will hold, because this difference is drastic. The same thing works on the other side. Let's say that the NASDAQ right now is trading at negative 1%. And let's say the NASDAQ futures are projecting plus 2%. Well, if I see this, I'm like, okay, wow, something must have just happened in the news. Something came out that have made people so sure, they're betting their money on the fact that the NASDAQ is going to basically go up 3%. So we're negative 1 to negative 2. That's a big jump. So that gives me certainty. I can look at that. So if it's before the market opens and the futures are at negative 1 and the market opens and it does its thing, if something happens and I look at the futures again and I see plus 2, I'm thinking to myself, okay, wow, people know something I don't. Something is going on. And usually when you see this, like when the futures are 2%, you're going to see some pretty wicked, like your stocks are going to be spiking up and, your stocks are going to be going up in a good direction. But this tells me something significant has happened. This gives me more certainty. So the greater the difference, the higher the certainty the certainty of what will happen in the future, of what is projected uh, to happen in the future will actually happen. So you can use the futures to help, set you up for what you should expect. Really, only when, in my opinion, this is my opinion, when you have a pretty big discrepancy between where the market is right now and where people are projecting the market to be. If you see this, so the Nasdaq is, you might see this like 0.025%. That's where it is now. If you see the Nasdaq futures are at like 1.026%, there's virtually no change. What this tells me is that people aren't really sure. There's very low confidence in how the market might be different in the future. And when you see this type of tight grouping between where the market is and where it's projected to be, you have to be much more careful in the positions that you take. If I see this, I can actually place bets pretty aggressively. So for example, if I bounce back, I'll go back to here and I'm going to pull up one of my stock charts. Let's say it's Target right here, and Target had a bit of a dip, if you can see. And, maybe I'll even pull up Target to be a bit bigger, so I'll do TGT right here. Well, let's say the market's opening right here, and the futures are projecting a 2% increase. Well, that gives me more confidence. So if you look at this, if you look at the greater context, Target's been having a rough time. A big sell-off for their earnings. Actually, if you want to know what this was about, so they released their earnings, and their earnings have disappointed. Target's in a really bad position. But during their earnings call, they released that they were identifying a new CEO, and they named someone who was already part of a company. And that disappointed investors greatly because investors were hoping that they were going to get like an outsider that could maybe shake up the company, but they chose an insider. The stock sells off. So the context for Target is that there's already upside potential from this big sell-off here. Now, let's again go back to the futures. If the futures are projecting a 2% upside from where we are, since that's so different from where we're at now, remember, negative 1% is where we're at now, and the futures say 2. I could place a larger bet down here. I could even bet like 40 shares. That's almost $4,000, or 50 shares, 5,000. I have more confidence. I have some data to suggest that give me more confidence that it's more likely that this stock is going to go up, and even aggressively, during those opening few moments of the market than down. And you can always be wrong. See, that's the name of the game. Even with futures on your side, you can always be wrong. But if we look at this stock, it's already sold off a lot. A lot of negativity has already been priced in the target. And if I see the futures being positive, this can give me more confidence to place a larger bet here. Now, contrast that with going back to this example, where the difference between where the market is and where it will be is pretty much unchanged. If I see this, I'm going to be far less likely. I'm going to be very, very, very cautious about opening up a position here. In fact, I'm probably going to wait to see what actually happens in the market because there's more uncertainty there. So this is just a quick little tidbit on how you can utilize the futures to help you make informed decisions about the manner in which you should be entering trades. Remember, the bigger the difference between where the market is and how futures and traders are projecting it to be, the greater that difference, either positive or negative, the more certainty you can have that the market's going to move in that direction, either high or low.